We're now joined by Paul Miliotis and Paul Mirren from Msquared Capital. And I'm interested to gauge what's happening to their part of the market, their sector, with this current lockdown. Guys, thanks for joining us.
Thank you, Peter.
So can you give us an idea? I know, Paul, you wrote a story recently about the lucky country, particularly because of our property sector. Why did you say that?
Well, look, during the last 12 months, or since COVID, Australia is only one of the 3 countries in the world that's economy was larger post-COVID than before COVID. Now, I'm not sure if I'm feeling lucky right now during this current lockdown, but Australia has performed exceptionally well during the crisis because of a couple of different reasons. One, because of the government support, the fact that we're able to control the virus, the fact that property prices were very, very stable during that time, and consumer confidence was good as well. So we've performed exceptionally well, but however, with this current lockdown, some of the gains that we've had in the last 12 months, I think will be eroded.
Okay, let's go to that now, because you guys, you operate in a sector, you're at the professional end, if you like, rather than the residential end, but the residential prices have an implication on your type of investing. So what has the lockdown done so far?
Well, look, I think there's a very substantial difference between last year's lockdown and this year's lockdown. We're actually seeing confidence from borrowers and investors unchanged, whereas last year we saw a lot more fear into the market as well. And I think there is a little bit more certainty as well that we're eventually going to get out of this situation, and it's not a matter of if, but when.
Look, in terms of our sector, Peter, I might just add something there. Because in Msquared we're backed by property, the majority of our property being residential. Initially, when the first lockdown happened, a lot of our investors didn't know, or borrowers for that matter, didn't have a view on where the property prices would have gone. So they had a little bit of nervousness in terms of where the underlying security values were being. So once we came out of lockdown, we actually saw, and this was a prediction by Msquared, with low interest rates, that the property prices were going to increase, and they increased significantly. This time, everyone does feel a little bit more wealthy, particularly in your Sydneys and your Melbournes, where their own homes have gone up in value. So coming into this lockdown, our investors and our borrowers are confident that the underlying security values are there. And with that has come a different confidence in terms of our sector. A lot of our investors are telling us they've actually been living off the monthly distributions from investing in our sector, and they can rely on those monthly distributions. And when people are, even when construction lockdown is happening now, or when your cafes are closed, people that are investing in our sector and getting their monthly returns, it does give them a lot of confidence.
Yeah. Can you tell me this, guys? Have you had any borrower clients who are terribly exposed to the CBD? Because that's something I don't think fairly you would have thought about, say, 2 years ago, if you provided funds to somebody who might have had a great business in the CBD area and they were borrowing. Have you encountered something like that, or has good luck, in a sense, followed you?
Funny enough, it hasn't been the borrower side, but we had a few of our investors who are significant cafe owners in the middle of the CBD in Sydney, and they were significantly invested into Msquared facilities. And when lockdown 1 happened, they were in dire straits. They needed the cash flow. They needed their monies back. So from a borrower perspective, we're actually quite blessed that we didn't have direct exposure to businesses, particularly in the CBD. We actually made active decisions after lockdown 1 to be careful in certain sectors. So we haven't lent to publicans. We haven't lent to cafes. And I do feel for them, but we did see increased risk in retail sector as well. But from an investor side, a few of our investors that had businesses, really successful businesses, had to change direction and get some of their capital back to shore up those businesses.
And the flip side, I guess, Paul Mirren, would have been that maybe some suburban business borrowers are actually a lot less of a worry because their businesses are going through the roof.
That's right. So look, there is a bit of a disbalance at the moment, and we are going through that phase as well. There's no doubt about it that this time, in this particular lockdown, you have to be a little bit more careful of the borrowers that you lend to, because the government initiatives are not as generous as they were before. And unfortunately, if I'm looking at retail, if I'm looking at retail commercial, if I'm looking at cafes, if I'm looking at travel, some of those businesses are at risk of not being able to open up after coming out of this lockdown.
Yeah, and I guess some of those businesses that you've lent to who are based in the suburban areas, they're arguably going to be better forever because of the hybrid working model that's likely to be in place.
Yeah, absolutely. Look, we're looking at an opportunity at the moment, which you would not consider to be a very buoyant business, but they've doubled their turnover in the last 12 months.
Yeah.
You would never think of it. So look, there is a bit of a disbalance. We're being a lot more cautious. We're being more analytical in relation to some of the businesses. There are some patches where we will avoid, and there's some patches which are doing very, very well.
On that note, one thing to note in our business, particularly, Peter, is while the underlying business is very important from a cash flow perspective, our investors can rely on, in the unlikely event that we did have to recover the monies, we always only lend to people that are backed by residential, commercial, or industrial properties. So while analysing the business from a cash flow perspective and ability to service the debt is extremely important, what you fall back on collateral for our particular business is very important. We won't directly invest purely into a cafe, for argument's sake, if we don't have a property backing that particular loan. While we don't want the businesses to fall over because it does affect the cash flow and you'll need to recover the monies, the underlying security is always backed by property.
Yeah. So guys, what are the opportunities you're seeing now in this changing environment?
I think, look, we are very nimble and we're finding a lot of opportunities. I think we're actually busier now in lockdown than we were before lockdown. We're seeing a great depth of interesting opportunities because we're able to move very quickly on it. I think the biggest fundamentals for investors comes down to 3 rules. Is that being invested in the market all the time. So not to be afraid. So for example, the biggest lessons that our investors learned from the last lockdown is that if you can, opportunity cost, if you can make 6.5% return, why not do so? So 1 is being invested, 2 is understanding the fundamentals of risk, and 3 is also to understand, to have diversification as well. So if you have all your eggs in one basket, for example, it's not necessarily the best thing. And the reason why you have diversification is because when you have situations such as this, you even out your returns and you still have liquidity.
And from a borrower perspective, Peter, maybe I can add something to that. The banks are struggling at the moment with people working from home in terms of speed. Borrowers still need to have those purchases complete. They still need to use equity to push into their businesses. So there's an opportunity to get high quality borrowers that we wouldn't have historically been able to attract because our returns are higher than the banks, significantly higher than the banks. But when you've got the certainty that we will deliver on the borrowers in a specific time, that is a major reason why borrowers are coming to us. And our investors are getting probably the best arbitrage we've seen from monies either held in term deposits and lending out to these type of mortgage investments than we have in our history. So the arbitrage is great for our investors. The underlying securities are good as well. So it's kind of a perfect storm for our sector.
Yeah, we need to change that term. Perfect storm always seems to be like, it's supposed to be good, but a storm's not good. Maybe a perfect zephyr, but it doesn't have the same effect, does it?
I'll let
Guys,
you take that one.
Thanks for joining the program. Talk to you in a few weeks' time.
Stay safe. Thanks, Peter.